So when you look at the US economy, on the surface, everything seems, well, amazing, right? But if you peel back just one layer, a totally different and much shakier story starts to take shape. A story about deep cracks spreading through the very foundation. Okay, let's dive right in. The big headline number, the one everyone's talking about, is just impressive. The latest figures show the economy growing by more than 3%. I mean, that's one of the strongest performances in the entire developed world, and it really paints this picture of incredible strength. But here's where it gets really, really interesting. That national number, it's kind of an illusion, because when you pull back the curtain, you see that of the 50 states, only 16 are truly growing. 13 are basically treading water, and a staggering 22 states are actually watching their economies contract. That's almost half the country in a localized recession. To really understand how this is possible, we have to start in America's industrial core, the manufacturing belt. This is where those first cracks in the foundation are really starting to show. And you can see right here, this isn't some new overnight problem. Manufacturing as a piece of the economic pie has been shrinking for over half a century. Back in the 60s, it was a full quarter of GDP. By the 90s, it was down to 15%. And today, a mere 10%. It's been a long, slow bleed. What's fascinating is that the very policies designed to reverse this trend have, according to reports, had the exact opposite effect. The plan was to use tariffs to make American goods more competitive. So what happened instead? The manufacturing belt has reportedly lost over 40,000 jobs, and the whole sector has been shrinking for months. And hey, this isn't just a theory. Analysts from Goldman Sachs dug into the numbers, and they estimate that the vast majority of the tariff costs, well, they aren't being paid by foreign countries. They're being paid by American businesses and families through higher prices on everything. So what you have is this double whammy. On one side, tariffs are making it way more expensive for factories to get the raw materials they need. And on the other side, stricter immigration policies have led to these critical labor shortages, so it's harder to even find the people to build the products. It's a squeeze from both ends. But the damage, it doesn't just stay on the factory floor. Now we're going to see how those exact same forces, tariffs and labor shortages, are kicking off a brand new crisis in a totally different part of the economy, America's heartland. First, let's talk prices. In just the last couple of years, the price of key crops like soybeans and corn has absolutely plummeted by nearly half. A flood of cheaper international supply is making it incredibly hard for American farmers to even compete. Then, you've got the labor issue. I mean, even if farmers could compete on price, they can't find the workers. With the migrant labor pool shrinking, some farming regions are reporting just staggering vacancy rates. Over 40% of farm jobs are just empty. And finally, the trade war hits back hard. In response to US tariffs, other countries went right after American agriculture. Midwestern states alone have reported losing upwards of $3 billion as their biggest international buyers basically vanished overnight. Okay, this next part is a really critical concept to get. It's called a margin call. See, a lot of farmers use contracts to lock in a price for their crops ahead of time. But when prices fall and they can't deliver, they face a margin call. It forces them to pay cash they simply don't have. For many, it's the final nail in the coffin. And the real-world impact is just stark and devastating. In Nebraska, farm bankruptcies have jumped by nearly 30% in the last year alone. In places like Kansas and Iowa, net farm income has dropped by a quarter since 2023. We're talking family farms and major corporations alike just having to shut down. So this is the point where the problem starts to spread. It stops being just about farms and factories. It becomes about the web of debt that connects them to the entire financial system. You see, when a farm fails, its debt doesn't just disappear. It gets passed up the chain to the regional banks that lent them the money. And those banks have poured over $450 billion into the agricultural sector. That money, once considered a super safe bet, is now suddenly at risk. And that creates a cascade of losses that can spiral out of control. This whole problem is part of a much wider issue. You have to remember, for almost a decade after 2008, money was cheap. Interest rates were practically zero, which encouraged everyone, households, businesses, you name it, to borrow massive amounts of money. Sure, it kept the economy growing, but it also created this enormous mountain of debt. Now, you might look at this and think, well, manufacturing and agriculture are a tiny part of the economy, so who cares? But the problem is, this debt issue isn't contained. Even in these really prosperous service-based states like Illinois, Massachusetts, and Texas, the average household owes 130% of their annual income. The entire system is leveraged. So, what about that one bright spot, the engine that's been pulling the whole national GDP number up all by itself? Let's take a look at the AI revolution and ask if it's as solid as it seems.
The reality is that almost all of that 3% national growth we saw at the beginning is coming from just a tiny handful of states, places like California, New York, and Washington, the epicenters of the AI and tech boom. Some estimates say it's as high as 92% of all recent growth.
But even this explosive growth is built on shaky ground. It's all fueled by borrowed money. Major tech companies are operating with these enormous debt-to-equity ratios. I mean, take Oracle. For every dollar the company actually has, it's borrowing 5. It's a massive bet on future profits. So here's how it all connects. Lenders fund these risky ventures, like AI startups, with the steady, reliable income they get from so-called safe sectors, like mortgages and farm loans. But as those safe bets start to default, that reliable cash flow dries up. The banks get nervous, they pull back on risk, and the very first place they cut funding is the speculative AI sector. And we've seen this play out before. In 2008, it wasn't some exotic tech startup that brought the global economy to its knees. No, it was the collapse of what everyone considered the most boring, reliable investment in the world: housing. Today, the setup looks eerily similar, only this time the potential fuse is a mix of farm loans, factory closures, and tech companies built on leverage. So the American economy appears strong on the surface, but really it's being held up by a handful of high-growth sectors funded by debt, while its traditional foundations are cracking. And this leaves us with one final and pretty unsettling question: which domino will be the first to fall?